Hey everyone, thanks for joining us today. My name is Eric Hartman. I'm one of the programming librarians with Charlotte-Mecklenburg Library. Joining us today for Investing Basics is Angelica. She's the Member Engagement Specialist with Sharonview Credit Union. And then Yolanda is the Linkso Private Ledger Registered Service Associate, also with Sharonview. Again, thank you guys so much. I'm going to pass it off to them.
Great. Thank you so much. Thank you, Eric, for this opportunity to allow us to sort of coordinate this presentation for the library, the members of the community that are part of your library, and any of the branches overall in the library. And with that said, I'm going to move it over to Yolanda. Just again, thank you for allowing us the opportunity to be able to present this investment basics presentation. I think there's going to be some valuable information, some tools and resources that Yolanda will share with you all. And we look forward to presenting. So if you'd like, if you do have a comment or a question, we ask that you put it in the comments. And we're going to do everything in our power to answer as many as we can this evening. But if we're not able to answer any questions this evening, of course, Eric will be able to provide some information to you. We'll have our information provided to Eric so that you can contact us at a later time with any additional questions you may have for Yolanda or someone in Yolanda's team. And with that said, I will go ahead and pass it on to Yolanda.
Thank you, Angelica, and good afternoon, everyone. Again, my name is Yolanda Wilson, and I'm a registered service advisor here at Sharonview Financial Services, where we use LPL as our brokerage platform. Now, our financial services division is headed by Dwayne Clendaniel, who's also the lead financial advisor here at Sharonview. Our financial services team helps with all aspects of investing as well as retirement planning. So today I just want to spend a little time talking about the foundations of investing. Your investment strategy plays a critical role in developing and sustaining a plan that will help you achieve your investment goals. A component of achieving those goals is making sure you have realistic expectations. When choosing to invest, you want to make sure you are comfortable with your investment choices because at times the market can become very volatile. Market volatility simply means that the market may go up and then it may go down and go back up again. So we'll take a look at that and we'll see the impact that being an emotional investor can have on your investment strategy. We'll also look at ways to determine how to pick an investment strategy that works for you. Next slide. Okay, so one of the more important pieces of building a solid investment plan is going to center around asset allocation. To help you become a more effective investor, we'll discuss what asset allocation is and why it is important. We'll also look at some tools that can help you determine what your asset allocation should be. You will hear me mention the word diversification quite often. Diversification simply means having a well-balanced portfolio. It's all about the balance. So having a well-balanced portfolio, it comes from choosing the right investment mix. So what exactly is asset allocation? The technical definition states it's the process of strategically dividing your dollars among different types of investments to pursue a specific investment goal in the most effective way possible. Simply put, I'm sure we all have heard the saying, do not put all your eggs in one basket. That's exactly what it means, because if your basket spills, all your eggs could break. So why is this process important? It's a critical step in putting together your investment portfolio so that your savings have the potential to grow over time and provide a secure financial future. Although there are no guarantees with investing, diversification and having a good asset allocation may help you maximize your potential investment returns, while at the same time, you effectively manage your investment risks. Again, it's all about balance. When you create balanced meal plans, you use multiple food groups based on your dietary needs, and the same principles can be carried over to investing. You'll want to have multiple pieces in your portfolio that work together to get you to your goal. You'll want to make sure that your strategy you choose is well balanced and something that won't cause you to lose sleep at night. When the word investments is brought up, most people think of stocks and bonds. Having the correct balance of stocks and bonds will put you on the path of obtaining your financial goals. One of the more common ways to obtain this type of balance of stocks and bonds is through mutual funds. Okay. So basically, a mutual fund is a basket of investments. When you invest in a mutual fund, your money is pooled with the money of other investors who have the same or mutual investment goals. It allows you to have access to any different mix of stocks, bonds, cash, and other stable assets. Mutual funds offer an easy way to diversify. Instead of you choosing individual companies to invest in, which can be very time-consuming and not very cost-effective, the professionals who manage mutual funds, they use the pooled money to buy and sell on your behalf. If you are involved in an employer-sponsored plan, you may notice that the majority of the options presented to you are mutual funds. And I do want to mention a side note. If you're not participating in your employer's retirement plan, you should really consider it, especially if your company matches. Okay. But you can find a mutual fund that has an investment objective that supports your investment strategy and goals, along with your risk tolerance and your investment time frame. The next slide will show two of the more common types of mutual funds found especially in retirement plans and education savings plans. So increasingly popular, particularly in retirement savings plans, are target date funds and lifestyle funds. So a target dated fund specifies a year in which investors expect to need to start drawing money out of their investment account. In retirement plans, such as those offered by your employer that you should consider going in if you're not participating, you would have to choose the target dated fund that has a year close to your anticipated year of retirement. For example, suppose I'm participating in my company's 401k plan. I may choose the target date 2050 fund. What that means is I plan to retire around that time frame. And instead of saying, oh my goodness, I have 30 more years to work before I can retire, I try to look at it as, oh wow, I have 30 more years to continue using my investment strategy so that my assets can maintain my lifestyle. Now, do I really use those words? Not particularly, but I do know that is true, and I do keep that in the back of my mind to keep me as a disciplined investor. So right now, that 2050 fund is going to be mixed of stocks and bonds. Today, it's going to have a higher asset mix of stocks and a lower mix of bonds. As we get closer to the year 2050, that fund manager is going to reallocate the assets in this fund so that it gets more conservative as we approach year 2050. And while your principal isn't guaranteed, this is to increase the chances that your principal will be there when it's time for you to retire. So the bonds will make up a relatively small portion right now, but as you get closer to that year, you will see an increase in the bond percentage, because bonds are normally used to stabilize a portfolio. Now, as the target year 2050 approaches, they're going to move to the more progressive approach. Oh, you can go back if you don't mind to the prior. Thank you. So the difference between the two, a life cycle style, this one has a set asset allocation mix and it will not change. So if you know the type of investor that you are, say if you're younger, you may think that you can be an aggressive, you will pick an aggressive mix and it will stay that allocation throughout the time that you're in that fund. So if you choose a fund that's 70% stocks and 30% bonds throughout the course of that fund, you'll always have that 70% stock and 30% bond. So keeping in mind with these two funds, you can take a hands-off approach, but it is important to go back and revisit your account if you have any lifestyle changes or if your time horizon changes as well. Okay. Now, every type of investment is associated with some type of risk and return. Here you can see our risk versus return spectrum. So starting at the bottom, the U.S. Treasury bills are generally the less riskier type of investment, but the return potential is also not going to be high. In this illustration, a balanced fund, we're using the example of something that's 50% stock and 50% bond, and that usually comes about midway throughout the chart. At the very top of the chart, we have international stocks. Now, those are one of the more riskier investment pieces, but those also offer the higher return potential. So what's important here is you want to make sure that your investment portfolio has some of every component so that you get that well-diversified portfolio. Again, it's all about the balance. So now there are many factors that have an impact on your asset allocation strategy, such as how many years you have until you need the money, your current lifestyle, and your financial situation, and what you want to pursue once you enter retirement. A good tool to start with this is this quiz in the asset allocation flyer, which will be posted on the website. So it will identify what type of investor you are and give you an indication of how you feel overall about investment risk. A key factor on how you think you would handle the occasional and unpredictable changes in the value of your investments is important. You need to know how much uncertainty you're willing to take on. We often refer this to the roller coaster of investing because the markets will go up and they will go down and they will go back up again. And it's all about how much roller coasting you can tolerate. Once you have an idea about your risk tolerance, you need to strengthen your knowledge of the type of investments available in your portfolio, which we'll cover next, and then the risk involved in investing, which we will also cover. An important consideration for settling your investment mix is project how much income you'll need in retirement. So the question of how much will I need is a question that we get quite often. And my answer is always, well, it depends. So things such as your lifestyle choices post-retirement may affect the amount of assets you need. Again, it's very important to make sure your investment strategy is aligned with your goals. If you don't anticipate many lifestyle changes once you retire, many financial experts estimate that you will need about 75 to 100% of your pre-retirement income to maintain your standard of living once you quit working. Now, if you decide you want to buy a yacht and travel the seas or become an international travel, you have to want to accommodate for those extra expenses. So how will you make up your lost income? Social Security may be a partial supplement for your income. It won't cover most people's entire lost income. So having a retirement or investment portfolio can make a huge difference on how your retirement days look. Another important question that we get asked quite often is how long will my money last? Well, experts say plan to live in retirement for at least 20 years. A 65-year-old man can expect to live to 84, and a 65-year-old woman can expect to live to 86 and a half. As your life expectancy increases, so will the cost of living. You also have to consider outpacing inflation rates because $1 today will not be worth $1 tomorrow. Strategic investments will take inflation into consideration as well. Now, speaking of inflation, this chart shows the impact of inflation over many years, and it can rob you of purchasing power, and many require more growth-oriented investments than you think. So just looking at the chart, back in 1990, a gallon of milk on average was $2.78. Last year, it averaged out $3.35. And in year 2050, when I'm expected to retire, I can expect a gallon of milk to cost $8.13. A movie ticket back then was $4.23. Last year, it averaged $13. And in 2050, it's going to be almost $32 for a movie ticket. So I hope that Hulu and Netflix are still around because I doubt that I'll be going to the theater. And looking at mid-price cars, back in 1990, $17,000 would get you a mid-price car. Last year, you had to pay about $33,000. And in 2050, we're looking at $80,000 just to get a mid-price car. So again, you want to make sure your investment strategies take in the fact that inflation exists and you want to assume a 3% annual inflation rate. Okay. Speaking of over time, in the words of the infamous Benjamin Franklin, we all know that time is money. So the role of time in building up saving is very powerful. The earlier you start, regardless of how much you save each pay period, the better your chances of having a financially comfortable retirement. You may have heard, or you may have not have heard, of something called the rule of 72. It's a way you can estimate when an investment will double using a rate of particular interest. As you can see from this chart, you'll divide the number 72 by the interest rate you believe you will earn. So in this example, we're going to use the hypothetical 8% return. So every 9 years, someone who earns 8% on their investment can expect that investment to double. So if you pretend for a moment that someone aged 20 has saved $10,000 and they don't put anything else into this account and they average 8% a year, their investments will double 5 times by the time she's 65. That $10,000, without adding anything else to it, would be worth $320,000. Very, very powerful. Now, just think what would happen if you also added money along on a regular basis. And another side note again, if you're not participating in your employer's plan, you should seriously consider it. Now, this chart here is hypothetical, of course, and it doesn't consider the fees that may come with investing, and your results may vary, but it is a good illustration of the power of time. So the earlier you can invest, the better, and it's never too late to start. Now, the key takeaway from this is compounding is powerful. If your retirement seems so far away, then that's great, because a small sacrifice now, when you are younger than you will ever be from today moving forward, it may help you avoid having to make much bigger financial sacrifices later as you get close to retirement. Now, there are many goals of diversification, so we'll spend a few moments on this slide in particular. So thinking back to the meal plans, when you meal plan, you like to make sure that you take enough of each food group to make a balanced meal to make sure that you stay healthy. The same thing can be applied to investing. The goal of diversifying is to make sure you have enough of the different asset classes to make sure your financial life is healthy. There's an interesting story of an entrepreneur that demonstrates the importance of spreading your investments, which is one of the goals of diversification. So we all know about the Lifesavers candies. So that was invented in 1912 by a guy of the name Clarence Crane. And when he first introduced Lifesavers to the public, there was only one flavor, and it was called peppermint. A year after creation, another gentleman by the name of Edward Noble, he approached Crane and suggested that different flavors of Lifesavers would probably attract more customers, meaning more business and increase in sales. Crane wasn't interested and declined, but he did agree to sell his business to Noble that very next year, and he sold it for less than $3,000. Noble went on to develop a billion-dollar business by making different flavors of Lifesavers. By diversifying his product, he appealed to more people. More importantly, he protected his business from the risk of that one flavor losing popularity. Diversification works the same way with investing. In terms of investing, you want to spread your money among different types of investments, stocks, bonds, and other stable value assets in order to balance the risks. Now, while there's no guarantee that a diversified portfolio will enhance your overall returns, it may help you diversify your total return potential. The confidence that comes with having a well-diversified plan may also help you avoid the temptation to switch in and out of the funds in hopes of finding a better return. Taking the emotion out of investing is a very difficult thing to do, but it is one of the more important pieces because there is no emotion in investing. Now, balance risk is also another goal of diversification, and that just helps you manage the risk that you have that comes along with investing. So we talked about the various types of risks. But you can manage your market risk by considering stable value or cash equivalent investments like money market funds. And a lot of times, bond funds are added to help stabilize your portfolio. Generally speaking, stocks and bonds have an inverse relationship. And what that just means is when one goes up, the other goes down, and that produces some type of balance within your portfolio. As you'll hear me say many times, it's all about your balance. And then another thing to take into consideration is you want to avoid overlap. To make sure your funds are diversified as you would like them to be, you need to examine your fund's prospectus and its annual and semi-annual shareholder reports. These documents describe the fund's investment strategy, the risks, the performances, the top holdings, and sector and industry allocations, because you don't want to have all of your assets invested in the same companies. Okay, and then also adding asset classes can help you achieve your goal of diversification. That's a good way to help you avoid overlapping your holdings. After selecting the right mix of stocks, bonds, and cash, you can drill down further and explore the different segments within the stock and bond markets. Investing in a variety of funds can lessen your likelihood of overlap. It can improve your portfolio's diversification, and it can help you manage risk. So you might want to consider further diversifying by combining international with U.S. stocks, or by investing in government and corporate bonds in short-term and long-term bond funds. And most importantly to me, I think, when it comes to the goals of diversification, you want to review and rebalance your accounts on a continuous basis. So creating your investment strategy is only the beginning. As a disciplined investor, you should dedicate yourself to reviewing your strategy on a regular basis to make sure it's consistent with your time horizon, your investment return objectives, and your risk tolerance. As you get closer to retirement, or as you experience life changes, your ability to tolerate risk may change. Also, your mix of assets may shift over time because a fund in your portfolio may perform very well, or it may have been one that hasn't performed well at all. So generally speaking, you should look at your portfolio mix at least yearly and make necessary changes as needed. Financial professionals who actively manage accounts will do this for you on a regular basis. If you're not a do-it-yourselfer when it comes to investing, you may solicit the help of a financial professional to do it for you. Okay, so what type of investor are you? Staying true to your asset allocation strategy means you need to have discipline to monitor your investment mix and review it at least annually. Before you can truly commit to that responsibility, take a few moments to reflect on how involved you want to be in managing your investment account. For example, are you interested in learning more about investing and you have confidence in your ability to make the choices that are best for your financial situation? If so, you may be a do-it-myselfer. Or would you rather focus your free time outside the realm of investments, taking a more hands-off approach to managing your money? If so, you could be a do-it-for-me investor. If you decide you're more of a do-it-myself investor, there's several options available to help you get to your goal. You can mix and match from your investment options according to the criteria you set for yourself, or you can select a life cycle fund or a target dated fund that will reallocate and rebalance itself for you. If you align more with a do-it-for-me approach, your plan may have a managed account option. Under this option, you would assign the management of your account to a professional investment manager who will manage it for you, but this could come at a fee. Okay, and then not to get too technical, but I did want to spend some time just looking at some historical views of the market. So a bear market is considered when a market experiences a prolonged price decline, and it's usually considered when prices drop at least 20%. Now, the most recent U.S. bear market started among the coronavirus outbreak. The stock market crashed in the March of 2020 with the Dow Jones and the S&P 500 falling more than 20%. So let's take a look back from the end of World War II. There have been 12 bear markets and 11 economic recessions. And in 3 of the most significant bear markets in recent times, stocks fell roughly 43 to 45% and 73 to 74 from year 2000 to 2002, and about 51% during the 2007-2009 financial crisis. So a lot of us remember that and call it the 2008 market crash. And it's very hard to not be an emotional investor when you see your assets could potentially drop 51%. But if you stay the course, markets are cyclical, and on average, they will rebound within 24 to 25 months. Okay, and on the opposite side, a bull market is when the prices are rising or expected to rise. So this chart just shows some of the ups and downs of the market since the Great Depression, following from December 31st of 37 to December 31st of 2019. Now, as we can see, there are many ups and downs in this chart here. But the bottom line is, even when the market bottoms out, the ensuing 10-year period has a very positive average return. So the takeaway, try to stay the course and try not to be an emotional investor. Regardless if it's up or down, just remember your goals and stay the course. And then, of course, we mentioned earlier that time is money. And I love to show people this chart because I'm a numbers person and I don't believe it till I see the statistics and the numerical value. So this chart here is just a hypothetical growth of $10,000 invested in the S&P 500 from December 31st, 2004 to December 31st, 2019. So this is $10,000 added with no additional funds. Now, if you missed the best 40 days of the market during those 15 years, your account would only be worth $5,847 after those 15 years. Doesn't sound very good. If you missed the best 20 days, your account will be worth $11,908. A little gain, but still, to me, for 15 years, not worth it. But if you stay the course and you do not move your assets other than rebalancing, your $10,000 without adding anything else on top of it would be worth $36,418. So again, key takeaway, stay the course. Remember that markets are cyclical. They will go up, they will go down. But if you stay the course and remember your goals, then you have a better chance of achieving those goals. Try to take the emotion out of investing. If you cannot take the emotional part out of investing, it may be beneficial to you to solicit the help of a financial advisor or other financial professional. So what should you do in a volatile market? Because I said, of course, you should take the emotions out of investing, but that's easier said than done. We get calls almost daily when the market drops because people are nervous, which of course you should be. This is your assets. This is your life planning. So the first thing we want to do is breathe. Then you want to review your account balance, your asset allocation, and your fund performance. If need be, you should rebalance or reallocate your investments into a more suitable mix. You can always use an online savings calculator to determine how much you'll need to save. And then if there's a gap, just make plans to save more to make up for that gap. And then you can also reconsider plans for when you retire. If you decide to work 1 or 2 years longer, that's more money you can save and less you'll have to spend in retirement years. So Sharonview Financial Services, we do offer retirement planning that we can provide a baseline retirement plan. So what this would do is going to give you a realistic expectation in dollar amounts of what your retirement may look like based off what you spend now and what you anticipate spending in the future. We can offer specific changes that can be made to help you meet your goals if your retirement plan isn't meeting your goals. So that is something to keep in mind. We do offer those at no cost. And at the end of the slide, my email will be available. If you're interested in having one of those ran, feel free to email me. Okay, so just reviewing, I know we went over a lot of information. But we looked at the history of the volatility in the U.S. market, which we said it goes up, it goes down, but it will go back up again eventually. And what responses you might want to consider in the face of big movements in the market. So then we introduced the concept of asset allocation. It's all about the balance. The purpose of your asset allocation is to pursue a specific investment goal, such as saving for retirement in the most effective possible way. Side note again, if you're not participating in your employer and sponsor's plan, you may want to consider doing so. That is a great way to save for retirement. Now, it's an important process because it can help you give your portfolio opportunities to grow over time. At the same time, it helps you understand and manage the risks involved with investing. So a good starting point in asset allocation is identifying what type of investor you are and developing a personal investor profile. We looked at some of the different type of investments of asset classes that may be offered in your company's retirement plan or in your investment account. You could do things such as the target dated funds or the life cycle funds, which those offer automatic rebalancing and they're managed by fund managers, so you can take a hands-off approach. We talked about key investing strategies such as diversification. That may help you maximize your return potential while mitigating some of those investment risks. It will help you weather the market's ups and downs without making rash investment decisions such as buying high and selling low. We presented options for setting your asset allocation. You could either be a do-it-myselfer or you can be a do-it-for-me. There's no right or wrong. It just depends on your preference and your level of involvement that you would like. Now, to get the big picture on how certain investments compare when you consider potential return and the risk associated, we looked at what's called the risk-reward spectrum. Again, the international stocks were at the top with the U.S. Treasury bills at the bottom. The goal here is to have some of every asset class within your portfolio to get that well-balanced portfolio that you need. Having a multiple asset class inside it will benefit you. It will help you achieve your goals. Now, as your goals change or your lifestyle changes, it is important to reevaluate and make the necessary changes. And again, we say at least look at your portfolio at least once a year to see if you do need to make any of those changes. Okay, so we'll take a moment or two to answer a couple of questions if we can. And then also we'll also compile a list of questions that we can't answer and that will also be posted on the library's website. On this slide is my direct email. If you have any questions or if you want to get a baseline retirement plan ran, please feel free to email me and I'll be more than happy to reach back out to you and get that started. It is of no cost to you. I do appreciate your time today. And then, like I said, we will answer a couple of questions if we have time to do so. Thank you.
Great information, Yolanda. And it's a key takeaway, I think, as well with your presentation was, taking your emotions out of investing and your investments. That's extremely important. Just because, it's the overall psychology of spending money, right? Or handling your finances. I think It's extremely important to take your emotions away from it so that you don't feel like you're not making the right decisions when it comes to your investments. So that's a really important takeaway, in my opinion.
It is.
With regards to what you've presented.
And a lot of times, often than not, we have some clients who they just can't handle it for the moment. So of course we're going to do what the client likes. But hindsight is 20/20. And again, looking at that chart where if you miss the best 40 days, you could potentially lose out on a lot of money. But if you stay the course and take your emotions out and if you use a financial professional, just let them do their job, then you will see gains in the overall long time horizon.
Perfect. And we do have a question. We have one question in the comment section from Lashira D. Fullwood, and she is asking, what is the best way to transfer an old retirement account to a new account, especially a 403B to a 401K?
Okay, so that would be initiated with your current employer. Usually it's a very simple process. Once you let your current employer know that you have an old retirement account, they'll send you the paperwork or may be able to initiate it over the phone and get the ball rolling and to add it to your existing employer sponsored plan. That way you get the benefit of the compounding interest.
And that lifesaver story you shared, oh, she's Lashira Default says thank you. That lifesaver story is amazing. I would have never, I didn't know this story, but I would have never thought he sold it for $3,000 and the new buyer made billions by diversifying. You know, it's a great way to, it's a great concept to relating it to your investments and how you live your financial life or your lifestyle, financial lifestyle.
Exactly. Like I said, I'm a numbers person, and although I know it, by seeing the numbers in my face, it always opens up my eyes. I'm like, okay, this is real. This works, which it really does.
Looks like there was a question from Chandra about contributing to an existing pension plan still held at a previous employer.
I'm sorry, do you mind repeating that?
Chandra says, can you contribute to an existing pension plan still held at a previous employer?
Now, once you leave employment, you won't be able to contribute to that plan particularly. An option that may be available for you is to roll that pension plan or old retirement plan into an IRA. You can make contributions to that IRA, or if you're currently employed, you may also be able to move it into that employer's 401k where you can continue making your contributions as well.
Thank you, Eric. I missed that one. Chandra said thank you. She's asking, will it roll into a Roth or a traditional?
So you have the option to do either, but there are tax consequences if you roll it into a Roth. If your contributions were initially made with pre-tax money, you can easily move it into a traditional IRA. If you decide you want to move it into a Roth IRA, at the moment that you do the rollover, you'll be responsible for that amount that you roll over. It's going to be considered taxable income. So you have to pay taxes on it right then, but then it will fall underneath the Roth category moving forward. And then the benefit of having a Roth IRA is, of course, if you invest at least 5.5 years and then you wait till you're 59.5 before you do any withdrawals, everything comes out tax-free. So it depends if you want to pay taxes now or taxes later. So if you do the Roth, you're paying your taxes up front. If you do a traditional, you're not paying taxes until you take the money out of that traditional IRA account.
Chandra says thank you.
You're welcome.
Yolanda, Angelica, thank you so much for joining us today and doing this. This was such a great presentation. I know I learned a lot, and I really appreciate it. We'll go ahead and make sure that everyone who was on that email that I sent out the reminder, we'll go ahead and get that presentation. And guys, enjoy the rest of your day. Thank you so much.
Sounds great. Thank you so much, Eric. Thank you.